Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, December 7, 2015. And we didn't get the follow through, and you're looking at a daily chart of the SPDR or SPY that mirror images the S&P 500. And we didn't get the follow through that we should have gotten if we were going to see additional upside in this market from Friday. Friday had a nice big up day on volume, which generally will say, or generally will indicate, that we should see some follow through. And today's weakness tells me that the market is really in what I will call an unresolved position. It's kind of vying for a larger move in one direction or another. That's the way we need to read that. And which direction that will be is obviously the $64,000 question. But all in all, it's really not that hard to figure out. So here's what we've got. We closed at 208.35 today on the SPDR, and the downsloping trend line is not that far away. So if we just put it where we would come in the next day or so, we would just be above 110. Okay, 110 and a quarter, 110.30, in that neighborhood. If we close above that downsloping trend line here, this downsloping trend line, then we're likely to go to this next level here of resistance, and then the one which would be a double top from July. And if we cannot get above that downsloping trend line again right here, okay, then there's a high likelihood, and when I say high likelihood, I mean a very likely scenario that we're going to go down to somewhere in the 203.25 to 202.25 neighborhood, in this zone. Let me just mark it down right here, okay? That will be the likely scenario if we cannot close above, and I mean within the next couple of days. If we cannot close above this downsloping trend line in the next couple of days, then the market is likely going to roll over and finally make a concerted effort at some downside pressure down to the 203 and a quarter to 202 and a quarter area, give or take a couple of pennies here and there. And yes, the 50-period moving average, which is the upsloping trend line here, will provide some amount of support on the way down. But the fact that the other day we got below 205.48 and then pierced through it and then rallied back above it weakens that level, just because we already hit it one time last week, and that weakens that support level. Therefore, I believe that if we do not, one more time, close above the downsloping trend line at about 210 and a quarter, give or take, then we're going to roll over and see some downside momentum in the market down to 203 and a quarter, 202 and a quarter, in that neighborhood. We'll have more tomorrow. Tomorrow will be an important day. So the market could certainly be up tomorrow and we could touch the downsloping trend line. That doesn't mean we're still not going back down. All it means is we've seen some follow through to this afternoon's upside action in the market. Now, if we go to the intraday, let's go to the 60-minute chart, and you can see here that we rolled over this morning. Okay, this morning we rolled over. We found a low right here at the 207 and a quarter, and then the market just basically tested that low 3 hours in a row, or actually 4 hours in a row this afternoon. And then we peeled back away from it and made a little bit of a concerted effort at higher prices. So let's go back to the daily chart, and that's pretty much everything I have in the SPDR. One thing that's very, very interesting, now the SPDR only finished down less than 0.5% today, and after the close we rallied up a little bit, and the SPDR closed only down 1/3%. But from the daily chart close, it was down about 0.5%. But here's what's interesting. Now watch this. Okay, the IWM was weak today, down 1.29%, down $1.52, considerably more than the SPDR. That's very important. As you know, It's important that the risk assets had money flowing out, including the NASDAQ composite, which was down 0.75% today, still more than the spider. That's important information, and we need to take heed of that because it's usually and normally a leading indicator of the market on the upside and the downside. So my take on that is, if the market was going to give a further rally to the upside immediately, then the IWM and the NASDAQ composite would have been higher today, or at least outpaced the spider on the upside. Now, the transports were down 70 points today, down 6.66 tenths of a percent. So that's kind of an in-betweener, okay? It's down more than the spider, okay, but not as much as the IWM, so we'll call that a tweener. But it's making a bearish pattern, and we're below the level that I suggested was where the channel would need to hold, okay, right here. Okay, this is not an exact number. It's not a mathematical level in terms of the channel. It's just a channel, and we broke down below the channel, and we're making what seems to be a bearish pattern below the channel, below the bottom part of the channel, potentially making a bearish pattern for lower prices ahead of us. So I think that's important. And here's another area of importance. Now, we only talk about this every now and again, but when we do, it's important. Okay, the junk bond index, the high yield market, which is an indicator of companies that have to borrow at higher yields than the prevailing interest rates because their debt rating is below average, let's just say, and it forces them to borrow money at high interest rates. Many of the companies in the energy sector, and I'm not talking about the integrated oils like your Exxon Mobils and your Chevrons and your other integrated oil companies like BP and the like. I'm talking about the MLPs. I'm talking about the companies that were drilling for oil in the shale areas of the U.S., Pennsylvania, Texas, the Dakotas, and they had to borrow money at very high interest rates to make those projects go forward. Those projects are mainly on hold now only because the price of oil became so low that it doesn't make economic sense for them to continue to drill and continue to produce oil at the rates in which they would have to sell them at. They would be taking a loss. So those companies are going to have a lot of trouble rolling over their debt. Therefore, when their debt comes due, whether it's in 2016, in the beginning, middle, or end of 2016, right now the market is telling us, the high yield market is telling us that those companies will not be able to borrow in order to roll over that debt. And when I say roll over that debt, I mean refinance the debt that's coming due in the short term, within the next year, let's say. And rollover means that they would have to reborrow money in order to pay back the existing loan and roll out to another point in time where the maturity is not next year. The maturity is some point in the future. That's what rollover the debt means. The market is telling us, the high yield market is telling us they will not be able to do that. And that's one of the main reasons the junk bond or high yield market or index is melting away. Look at the weekly chart. That's just a better long-term view. It's below all the moving averages. It's making new lows on a weekly time frame and a daily time frame. And it's telling you that there's trouble on the horizon for this index, meaning there's trouble on the horizon for a lot of the companies in the high yield debt market. So I think that's very, very important to note as we take a look at the oil market or the crude oil market. In fact, we'll look at that first since we're on this topic. And look what's happening. This is a weekly chart, melting away, still yet again, below all the moving averages, making new lows. Look at the daily chart. Huge down day today. The crude oil market was down $2.25 today, over 5%. That's very, very ugly. Now, this market will find a short-term low and bounce at some point, but we're not in the business, like I always tell you, we're not in the business of catching falling knives. We're in the business of watching for a substantial market reversal or reversal signals. And by the way, today was on volume. This could be an exhaustion bar. It's possible, but we really need to see the market tell us that it's finding a low. We need to see a reversal. We need to see follow through. Each and every time we saw a reversal, we never saw substantial follow through, and we never saw the market close above important levels that I suggested that the market needed to close above in order to see substantial follow through to the upside, and hence all we did was reverse back down lower. So the next natural resistance, support area for crude oil is most likely going to be around the $36 area. Could we bounce before then? Of course we could. But that's the next natural area of support that we're looking for. We could see a reversal tomorrow. Of course we could. But this market is weak, and anybody trying to catch a bottom in this market is taking on, in my opinion, way too much risk than necessary. Let's wait for the market to tell us a bottom is in place, at least on the daily chart, and then we can find a pattern or a low to trade against, and that's the way you play markets like this. Other than that, just let it fall, let it come to us. Let's go back to the gold market. Now, the gold market, I know this is a busy chart, but there's a method to the madness. I want to show you something on the hourly chart that'll give you an indication of where we are in the shorter term. But on the longer term, on the daily chart, on Friday we came just short of the 1089. Now, what I did was I rolled over to the February contract and I put in my support and resistance levels, or at this point they're resistance levels, of translating them over from the other chart in December. But what I also did was I put in some fib levels to tell us where the likely stopping point is on this pullback. So what we had was we had a nice rally into the resistance point of 1089. And you know I've been saying this for quite some time. The market needs to trade above 1089 to get any kind of upward momentum and bullish behavior to the upside. However, let's look at where this pullback is taking us. This is the hourly chart. This is the area we went on Friday. 1088.30, I believe, was the number. The high was 1088.30. The low was 1045.40. What we've done is we've pulled back first to the 382 at 1071.91. We hit that, bounced off of it, very meager bounce off of that, okay? We only spent a little over an hour at that level, and then we broke through it. That tells us that the market wants to go through to the next likely stopping point or support level, which is the 50% retrace, which is 1066.85. Call it 1067 for argument's sake. Now, what happens at 1077? Well, there's a ton of support in this area, okay? All the time that the chart spent or the price spent in and around this level fighting this area tells us, the chart is telling us that that price level is important. If we do not hold the 50% retracement, there's another very, very quality and good level of support in and around the 618, where the chart or the price spent a lot of time fighting that level. Okay, in here, this is called chart vibration. This is called chart vibration. Okay, 1061.79, rounded up to 1062. The 618 retracement should provide a wonderful level of support, at least for an intraday bounce, if nothing else. So I just wanted to give you both perspectives. Okay, the market tried to recapture our 1089. It did fail, but it's only pulling back to a normal Fibonacci level or retracements on the hourly chart from the low to the high on Friday. Okay, the low was on the 2nd, and the high was on Friday, which was the 4th. Okay, so this is Wednesday's low, Friday's high. We're making a retracement of those pivot points, and that's what we're doing now. So I just wanted to give you the daily chart perspective and the hourly chart perspective. If the 618 does not hold, there's another level at about 1056, and if that doesn't hold, then we go back down to double bottom and potentially through to new lows. Just want to give you the whole picture. Okay, so how do you play that if you want to be long gold? If you want to be long gold, you can try the 50% retracement with a stop out below the 618. If you want to wait, which is the more conservative play at the 618, you can try the 618 with a stop at the 7.5, or call it below a close, an hourly close below 1055 just to be safe. Okay, hourly close below 1055, hourly close below 1061, 1060, in that neighborhood. Okay, this isn't a science to the penny. These are general areas that should hold within $1 or $2. Okay, so that should cover the gold market. Silver, much of the same story. I can draw in the fibs on the silver market. It's going to give you much of the same area or story. Let me just draw in the fib, okay? And this is pretty close. Let me draw it to the penny. Bear with me. Okay, those levels are good. And basically, we're much of the same camp, only silver is not as weak at this stage of the game as gold. So on your 60-minute chart or hourly chart, you can see we haven't yet come into the 382 retracement. So one market sometimes will feed off the other, sometimes it will not. They do not trade in tandem all the time, yet they do most of the time on a daily or longer basis trade in tandem, but not necessarily to the penny. However, what you can do with silver is, if you want to try the 382, you can try the 382 at 1428 and change, okay? And you can have a stop below, on an hourly chart closing basis, below 1426. Okay, that's a pretty tight stop. If it does close hourly below that level, it's most likely going to go to the 50% retracement at 14188. Okay, so that just gives you a picture of gold and silver. Go back to the daily chart, and let me just well, I'll leave it in there. You can see how both the charts are mostly in the same camp, but weak, maybe because of the dollar, maybe just because most of the commodities are weak, maybe it is because of the dollar, but nevertheless, I've given you the ways to play gold and silver, and I've given you the areas in which they will fail if they're going to fail. We talked about crude oil already. Let's go to the bond market. Okay. Okay, so on the 30-year bond, we had a nice big down move the other day off this top. And what we're doing now is we tested the top of this red candle here, which is natural in terms of these big down moves. Since we got two big up days, we tried to test the top. We did fail at this stage of the game yet. And therefore, unless we can close, it's pretty simple. Unless we can close above this red candle here at 157.14, okay, this market will most likely fail again to the downside. If we can close above 157.14, then we'll most likely continue higher. There's not much else we really need to know in the bond market at this stage of the game. That's pretty much the bookends as we have them. Everything really hinges on whether or not we can close above this red bar high or we fail. Let's take a look at the yield market just to get a different perspective. And the yield market is much of the same story. And the yields are coming down on the 30-year yield. And the same thing applies. If we cannot hold this green bar, which is obviously the opposite of the price of bonds, which is the yields, if we cannot hold this green bar low, which comes in at, I wish that would stop happening, which comes in at 2.925, okay, on a daily chart closing basis. If we cannot hold that, we most likely come down to this red line here, or fuchsia line, if you will. And first this double bottom, and then we would come down below the 200 period moving average down to this level here. That's what I've got calculated at 2.66, or I'm sorry, 2.86 to 2.85. That's really where that zone is. A lot of chart support in this general area here. That about covers the bond market and what we need to know. So let's see. We covered the stock market. We covered the junk bond index, gold and silver. We did crude oil. We did the bonds. We didn't do the dollar. Pardon me. Let's go over to the dollar. Okay, dollar chart. So we had an up day and then another up day after the big down day last week on the 3rd, which was Thursday. Okay, so we had a recovery day on Friday, another recovery day today. Now, what this is going to tell us, and let's just draw in a fib retracement to show you where we are. Okay, so here's where we are. We cut through the 382. We did not get to the 50. Okay. Today we rallied back to the 2.5 retrace and failed. But here's the interesting thing. So if the dollar continues up, maybe for another day, 2 or 3, let's say, okay, but we do not reach the high of this big down day, which is it's unlikely we're going to be able to get through that right now. Normally, these large big down days like this spell trouble for more downside momentum. So we would have a down move, we would have a wedge pattern, okay, this is a bearish pattern, and we would have another down move, and maybe we come down to the 50 or 618 retrace, somewhere in this neighborhood, and then everybody gets bearish, the dollar again, and that's where we would find another level of support, and then we would most likely start higher again. That's kind of the likely scenario for the dollar. We need to see more. The dollar needs to show us more. It needs to show us whether or not it's going to make that wedge pattern and then another down move, or it's just going to potentially recover all the way and rally back up again. I don't think that's the likely scenario. I think it's more likely we put in this wedge pattern and then one more down move, get everybody bearish, get all the bulls out, and then we find support at about the 96.5 to 97.25 area. And that's where we would most likely see some kind of a reversal signal, and that's when we would most likely see more upside momentum in the dollar from that point forward. And there you have it, folks. That's pretty much everything I had in the market today. With that, I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.